If you invest just $100 a month for next 30 years, you could make as much as $200,000 without being a genius in stock market. And if you double up your investing to $200 a month, you could make as much as $400,000. And this is the most passive way of investment. Want to learn how to do that? Then you need to learn how to invest your money the right way. That's right. Some of the world's wealthiest individuals owe their fortunes to the stock market. But here's the thing, many beginners are too intimidated to even take that first step into the world of investing. My name is Raj, and in today's video, I will help you break down those barriers and will give you the ultimate guide on how to buy stocks even if you are starting from scratch. So buckle up, this is going to be a long video with full of informations for beginners to intermediate investors, and I highly recommend to use some pen and paper to take some notes, and please watch the video till the end. You'll definitely get your golden nugget out of it. Before I start, I'm not a financial advisor and this is not a financial advice. So do your own research and let's get started. First of all, I'm not going to sell you anything on this course, and this is purely me helping you out on buying your first stock in the stock market. I'm making this presentation available to download, so please check the description of this video to get that presentation. So let's get started. Why should you invest in stocks? It is the best tool for growth because the stock market has historically provided nearly 10% return on an average since last century. And it has been said that if you want to be wealthier than the inflation in the market, you should technically invest in the stock market as a part of your diversification of your investments. It helps in battling the inflation. Keeping cash in your account can eventually lose its value. So you have to make sure that you are not just keeping cash but rather investing it somewhere, whether it's in a physical asset or in a digital assets like stock market. So investing your money is always considered as a better choice as compared to keeping cash in your wallet. As compared to probably 10 or 20 years before, it is very cheap to start investing in the stock market nowadays. There are a lot of discount brokerages available in any country which are basically giving you an opportunity to invest in the stock market with as low as $0 in fees and commissions. And most of them do not even have that minimum amount you need to invest or even keeping that amount of cash in the account or the yearly maintenance fees, nothing at all. All you have to do is just invest in any stock and get your returns. And if you don't like the hassle of being an active investor, you can invest in a broad market funds like BlackRock and Vanguard kind of funds are extremely durable when it comes to trusting because they are managing funds worth of trillions of dollars. Compared to before when people used to learn investing from the books, nowadays all this information is digitally available. One of that source is literally me helping you guys right now. If you want to invest, you don't have to spend a lot of time in learning how to invest, but rather you could follow people on Twitter, you could follow people on the news magazines, you could follow people who are doing these kind of videos on YouTube, and all these things makes it really easy to consume that information to take that first step on how to invest in the stock market and why it is way better than 10-20 years before to invest in stock market. Okay, now you got the idea. You should probably invest in the stock market. But what is a stock? Well, a stock is nothing but a share of ownership in a company. So yes, if you have an Apple stock, you technically own a little bit of piece of that company. If Apple makes profit, technically it comes back to you at some point of time. Consider this scenario as a pie or a pizza and you are getting a piece of that pie. So for example, if you own one stock of Apple and they have, let's say, 100 stock, you technically own that 1% share in the company. So any company, here I'm taking example of Apple, but you can consider this for any company, they have something called outstanding shares, and the stock or the share price has been decided based on the number of outstanding share and the valuation of the company, and vice versa. So if you want to understand what the market capitalization or the valuation of the company looks like, then all you have to do is identify the outstanding shares that company has and multiply it by the share price. Now let's understand how the market cap is calculated on paper. Let's say a company has 4 shares available to buy and you bought one share for, let's say, $50, and you want to understand what the market cap of that company looks like. So all you have to do is just see the outstanding shares, which is basically 4, and the price of per share, which is, or stock, which is $50, equals to $200. So in this case, the market cap of this company is actually $200. This is just for simplicity purposes, but you got the point, right? This you can do for any companies. It doesn't have to be a public company. Even if you are working for a startup and you have got some shares, all you have to do to identify what the share price is or what the market valuation is, all you have to do is find that market cap of the company. The market cap or the market capitalization changes every day with the change in the outstanding shares as well as the stock prices. The price of the stock is generally controlled by buying and selling that stock in the stock market. And retail investors or investors like you or me are considered very tiny piece when it comes to buying and selling in the stock market. The stock price is generally been moved when larger funds like BlackRock or Vanguard are making purchases or selling their stocks. Okay, but why companies provide these stocks? Well, they need to raise funds for their business. They want to make sure that they have enough funds covered for new innovations or the new product release they want to do, or even try to identify something new going on into the market and they want to capture that opportunity. People like you and me jointly are taking a share of that company and in return providing them the funds so they can start or do their business. It's as good as you asking your mom and dad or asking your friends and relatives for the money, but here we are just looking at this at a bigger scale. Now you understand why you should invest and what exactly is a stock. But let's understand how these different stocks in the stock market are categorized. One of the way you can understand the categorization of the stock market is through their market cap. Previously, before 10-15 years, there were only 3 different types of market caps, and they were small cap, mid cap and the large cap companies. But now, because stock market has expanded its horizon, you can have a huge number of varieties. For example, now we have different things called micro cap as well as mega cap as well. Most of the companies nowadays, like Apple, Microsoft and companies like that, they have crossed that $1 trillion mark as a company valuation, and they no longer fit into the large cap companies. They now sit into that mega cap companies. Coming back to our understanding of these market cap categorization. So mega cap stocks are the companies which are over $200 billion in valuation, and these are the larger fish in the ponds. Commonly, you would know many of these companies into your day-to-day lives. For example, the Apple, Microsoft, Coca-Cola, Johnson & Johnson, American Express, Google. The large cap companies, they have a range from $10 billion valuation to $200 billion valuation. Ideally, these kind of companies have proven track record in the industry. They exist since many years and they offer dividends. Mid-cap companies. These companies ranges from $2 billion valuation to around $10 billion valuation. These companies are more established than the small cap companies, and these companies are mostly the target for merger and acquisitions by those larger fish in the pond. Small cap. Generally, these kind of companies are prone to aggressive growth because they have a smaller valuation and they have a larger room for taking risk, and they can do a lot of innovations as compared to those larger fish in the pond. They are generally young in the market, so they do not have a lot of background in the history and often don't provide any sort of dividends or income to the shareholders. The micro caps, they are less than $250 million companies and just IPO'd. They are mostly funded by large funds like Vanguard and BlackRock, and they have a promising business ideas. So you can solely rely on your judgment of the industry or of the innovative product that they have in the market and think of investing in those, but they can boost the earnings by 10x, 20x, sometimes even 100x, depending on how much risk you are willing to take in those companies. The other way you can categorize the stocks are by the valuation or the ideation of the stocks, which categorize them into these 3 things. One is the growth stock, the second is the value stocks, and third is the income or dividend stocks. The growth stocks have the big potential in the market. They have faster growth and are moving very, very quickly, more volatile. Those are the Teslas, the Amazons, the Googles in the market, always are been known to be there in the news channels with some new innovative products or new ideas or new way they are cheering up their customers and clients and their shareholders. Typically, these kind of growth stocks are always reinvesting the money they make into the business, so they do not provide dividends, or if they provide, it's very less. The second is the value stock. They are basically trading below their PE ratio or price to earning ratio. If you do not know anything about the PE ratios, I'll explain later down in this video. Typically, these kind of stocks are needles in the haystack, so you have to find them. It's like a treasure hunt for you, whether they're overlooked or undervalued. And by understanding the fundamentals of the companies, you can identify these kind of stocks and can invest in them. They have a huge potential of growth in future. The third type of stocks are the dividend stocks. Those companies are not just regularly paying dividends, but most likely they are also increasing their dividends over the years. Some of the well-known companies who are regularly paying dividends to their stockholders are Johnson & Johnson, the Enbridge in Canada, and the Coca-Cola. Ideally, these kind of companies are regularly making money out of their business, and they are regularly consistently paying dividends dividends and increasing the dividends over time, and they have a proven business model which always works. The other way we can categorize stocks are through the industry sectors. These are the industry sectors which are commonly being mentioned when it comes to the stock market and identifying a stock into the stock market. And I'm sure you will know all of these industries, and you are indirectly or directly been tied up to all these industries in your day-to-day life. We have health sectors, we have materials sectors, we have real estate, we have consumer staples, discretionary sector, your utilities sector, your energy sector, industrial, consumer services, financial and technology. So sometimes the stocks do not just move on its own, but the industry itself is affecting the valuation of the stock as well. For example, a lot of time if there is a government rule which is changed or the economic situation is changed, it may heavily affect some sectors like manufacturing sectors. One of the common example we know is the COVID situation. When supply chain was disrupted, a lot of manufacturing sectors as well as health sectors were directly impacted. So at that point of time, you can see you do not have to look at the company individually, but you can look them as a sector and you can see a pattern out of it. Now you understand how these stocks can be categorized into different ways. Let's understand the risk in the market, because without risk there is no returns, and the more risk you take, you have potential of higher returns, but it's not always advised to take higher risk unless you have a higher appetite for that risk and you are open to lose that money you have invested in the stock market. And wait, I'm not only going to give you those theoreticals on how to buy a stock or what you need to do in the stock market, but I'm also going to give you a live demo through Wealthsimple on making your first purchase of the stock market, and will explain you all those technical gears which you need to understand before making your first stock purchase. So hang tight and please continue watching. The risk can be categorized by all these types of risk. The first one is the market risk, which basically says the price and the fluctuation in the market. Because if you are investing in the stock market, the market value changes every single day, the stock prices changes every single day. So if your money is in a stock in the market, you are prone to that risk of market going up and down. The next thing is the business risk. In business risk, you are often prone to risk of failure of the management. Sometimes the C board or the board of directors are not making the right choice for the company, and that may affect the valuation of the company overall. That may affect the major products they are launching or how they are working with the market, with their sectors, may result into poor earnings, may result into loss in the money or in the business, and ultimately will result into loss into the valuation of the stock which you have invested. The liquidity risk. If the company is into high debts or goes into the high debts, if they are providing dividends, they may cut those dividend values and you may lose that income you are generating out of those stocks and may get into the liquidity risk here. Taxability risk. If the government is increasing or decreasing the taxes for a particular sector or the industry, or adding some different forms of rules and restrictions for a particular sector, it may directly impact the stocks you have invested in. The interest rate risk. If the government is changing interest rate, for example, one of the common theme we have seen was just after the coronavirus situation when the inflation was very high, and as a result to basically reduce that inflation, the governments decided to raise the interest rate in almost all the countries in the world, and that not only affected consumers but that also affected those companies in the stock market, because those companies are taking debt from the banks, and when the interest rate on that debt rises, ultimately that company is going into higher debt and is going into liquidity risk. So that interest rate is directly or indirectly triggering that liquidity risk. Regulatory risk. If the regulation is imposed in any industries, one of the common thing I can tell you is the cannabis industries, where the government has a lot of restrictions on how you can use it, for what purposes you can use it. The health sector is always prone to the regulatory risk depending on the approval of the drugs or how it's been consumed in the market. Regulatory risks definitely is a big thing if you are working or investing in those sectors. Inflationary risk. The price of the raw materials increases. The way the supply chain works is through the supply and demand. If the demand is high and the supply is low, then obviously it increases the price of everything and inflates the whole market. And in that kind of situation, you may get into the inflationary risk if the business is relying on other raw materials or the products which they need to create their product or the services which they are offering. Now you understand different types of risk which you should be aware of, but how much you should take when it comes to your risk appetite. appetite. Ideally, it's been observed in the market, the more risk we take, we are definitely compensated for it. But it's totally on your risk appetite, on how much you are willing to invest and how much you are willing to risk when it comes to investments. It obviously depends on the stock choices you make as well. For example, investing in a startup is very high risk versus investing into your savings account or your GICs is low risk. It totally is your choice depending on when you exactly need that money to be out there or liquid to reinvest. But for example, if you want to get that money out in a short term, then you can potentially invest in a places where probably the returns are low, but you are guaranteed that you are not losing some money in it. I mean, definitely there is no guarantees, but it's still, there are lesser risk as compared to investing in a startup, for example. So at the end of the day, you should think and realize what your risk appetite looks like. You should know by following people who are actively investing, people who are making money in the market through that balance of risk appetite, and learn from that. Once you know what your risk appetite looks like, depending on your age, depending on your family situation, or depending on the money you are willing to invest, then it becomes really easy to just follow that mechanically without being very emotional with the market. Now we understand a lot more about the stock market. Let's understand what different type of stocks exist. The first and the most common thing you probably know are the individual stocks. Individual stocks are anything like purchasing a stock of Microsoft, or you're purchasing a stock of Tesla or Netflix or Google, whatever you like. Those are individual stocks where you are investing your money in an individual company. The pros for those kind of stocks are that there are no additional fees to buying those stocks. For example, you don't need to worry about the maintenance of the stocks. You just pay for the stocks, pay for the commissions to purchase that stock, and that's it. There is no additional management fees to keep the stock. Sometimes for different types of stocks, if it's a group of stocks, you may have to pay the management fees, but not in this case. You have a complete control over the stock. You can decide when you want to sell those stocks and when you want to buy more stocks, or average them down by purchasing more stock at a lesser price when the price is low. It's all your choice. It's easy to manage the capital gains and loss. The cons for these kind of stocks are that it's difficult to diversify. Imagine most of the people who are investing in the stock market and keeping their risk balanced is by making sure that they are investing into multiple sectors, sometimes into multiple different caps in the market, or even multiple companies in the same sectors, or generally the broader market, the whole market. You cannot go and buy stock from each company from the entire market. There are thousands of companies out there. So it's very difficult to diversify if you want to maintain individual stocks and the percentage of those stocks holding in companies. You have to actively manage that portfolio yourself. And there is always the fear of missing out if you are investing in a company in the same sector, but if you have not invested in the other company in the same sector, but the other company has done better this year as compared to the company you invested in, you feel like you are missing out on something and you end up buying that, selling this, and ultimately that company is not doing good and you come back to this company by selling that and buying this. You're wasting a lot of time there. So there is always confusion on your side if you are investing in individual stocks. So if you are really confident on any companies and you know that the future looks real good for that companies, then definitely go for individual stocks in that case. The second type of stocks are the mutual funds. So what generally happens is these funds or organizations are pooling money from individuals like you and me and are buying individual stocks. So as I said, if you want to do it on your own, you have to manage a lot of things that as good as having a paid job on a mutual funds company. What they are doing is exactly what you would do for individual stocks. They are buying stocks and selling stocks every single day from different companies, different sectors, different countries even, and they are giving you a portfolio with a risk profile and with how much money it can make and potential, all those accounting stuffs around it. These kind of funds are very liquid. They have a lot of money backed by different companies, different individuals like you and me. Sometimes millions of people are investing in the funds, which makes that fund highly liquid. The other thing is that these funds are managed by professionals who are in the stock market since like 20, 30, 40, 50 years of experience, and they exactly know what needs to be done way better than you and me, of course, and they manage your portfolio. So all you have to do is just make sure that you are finding the right mutual fund which fits your need. You have option of risk profile, as I explained. You can make sure that you want to choose based on what you want to achieve. If you want to achieve regular income with a lower risk and lower growth, then you can go with the income Balanced is something where you are balancing the incomes and the returns. You want fixed income where you get like monthly dividends fixed, but the growth is not that good. The diversity is included by default in most of the mutual funds. Cons here is that you have to pay a management fees, which is generally higher, somewhere between 0.8 to 1% to sometimes 2% of the investment. So if you are investing, let's say $100 every year, they will take $2 out of it from your investments. It's very hard to evaluate the capital gains and loss because even though the companies are making sure that they have all the information about what they have sold, what they have bought, you still have to calculate the capital gains coming out of these kind of mutual funds. Generally, it's covered in their fees and they actually give you a report at the end of the year which helps you with the taxations, but it's still harder than buying individual stocks for sure. It is not insured by the FDIC or CDIC in Canada, for example, and if you're losing money into these kind of mutual funds, for example, this mutual fund is not a company, right? It's a pool of the companies been invested in by some different person or an organization. So if they make bad choice and ultimately lose all your money, you do not have any insurance or coverage which can give you your money back. You cannot go back and say that, oh, you lost my money, give me back. That's not happening. The next type of stocks are the ETFs. They are basically the basket of stocks similar to that of the market sectors. For example, there will be ETFs related to the health sector. There will be ETFs related to the financial sectors. Sometimes there are even ETFs with mix of different sectors, and they work really well if you want to classify or diversify your investment into different sectors of your choice, but don't want to worry about investing it through the mutual funds or buying on your own. The excess here is very high or larger as compared to even mutual funds, because mutual funds do invest into individual companies at the end of the day, but these guys, they are literally buying the entire sectors. So it's very broad, and in the stock market we have this terminology is that the broader you go, the less risk you have and the higher chances of returns you have. They have lower expense ratios compared to the mutual funds. As I said, the mutual funds do have fees, but when you are buying ETFs, because those funds are not actively managing this portfolio, all they are doing is investing into this broader stock markets because it's easier to manage. The cons here is that if you are buying an ETFs which is very near to that mutual fund category, then you are paying a larger fees. So any places where you see that the returns are high and they are demanding probably more MER fees, it's because they are actively managing that portfolio. No risk profile control here, because you cannot choose that, oh, I want to have this ETF but I want to keep lower risk. You do not have a choice like that. All you do is just buy that ETF and sell that ETF when you no longer need it. The diversification is very limited to one or some industries here because you do not have a control over what you are buying. The ETF clearly mentions what they are buying in their report, and you have to make a choice whether you want to make that purchase or not. The next type of investments you can do is in the index funds. They are basically the basket of the stocks similar to the market index instead of the industry sectors. For example, if you want to buy the whole S&P market fund, then you can buy an S&P index fund, and these index funds are generally also been sold as an ETF, so don't get confused. They are basically also investing in the market index. Here generally it's very low fees because they are passively managed by the funds. They are highly diverse because they are literally covering the entire industry or the market in general. For example, the Canadian market has TSX, the American market has the Russell, the S&P 500 and so on. They are very easy to manage by the funds, and you do not have to worry about going and buying individual stocks. You can just buy the whole market. Here you do not have a risk control, of course, because you are buying the whole market here, and there is a lack of control over what you are holding because you are not just now exposed to one industry or one sector, but you are actually exposed to the whole market, which is generally been good. If you understand what Warren Buffett suggests is exactly this thing. If you are investing in the whole market on an average returning 9 to 10% returns, you are mostly crossing at least 40, 50 or even 80% of investors who are trying to actively manage their portfolios. If you do not like to learn more about the stock market, but if you still want to make sure that you are getting the benefits of the stock market, you should probably go for the broader funds, broader ETFs or broader index funds. The other type of stock is the REITs. They are basically the real estate investment stock funds. These are basically the companies who owns or operates income purchasing real estates. They are not investing in, let's say, stock market or in any other companies, but they are focused on the real estate sector. They are actually buying the real estate and making money out of it, providing it back to the people who have invested in these kind of funds, and they're actively managing it. Here, the difference is that you have the access to the actual real estate market, the housing market in your country, the housing market in any other countries. For example, in Canada, the housing market is booming since last 10 years, I guess, and people who have invested in REITs are making good money without being exposed to buying a home on their own or buying a commercial property on their own through REITs. They are highly liquid, as I said, being actively managed. They provide higher dividends because most of these companies, they provide 90% of their income at least back to their share owners. So you do not have to actually get $400,000 or $500,000 to buy a condo and then give it on rent. You can rather invest that $10,000 you have right now in those REITs and can still make the money like you are making money out of your rental income. All you have to do is find the right REIT which supports your need. It is good for diversification if you want to invest outside those stock market kind of companies and you want to make sure that you are also exposed to those housing market. The cons here is that dividends are taxed as regular income, unlike the dividends you get from the stock market. If you are getting a dividend out of this REITs company, then you do not get that dividend qualification benefits, but you have to pay the actual income tax on whatever money you are making out of it. It is obviously subject to the housing market risk. For example, what happened during the 2008 crisis where the housing market collapsed definitely and directly impacted those REITs and people who invested in those REITs. They have higher management fees, obviously, because this has not been passively managed or this has not been managed by sitting on your computer. They're actively managing those physical assets for you. It is very hard to diversify because they are choosing, just like mutual funds, the companies or the businesses or those commercial properties where they want to invest in, and you have to basically rely on their decision. They can invest anywhere from these categories like retail, residentials, offices, healthcares, lodging, resorts, timber, industrial infrastructure, those kind of things. As you can see that most of it has been invested generally into the retail sector. Now you know different types of stocks as well. Let's understand how you can evaluate a company before making that decision to purchase those stocks. To do that, you must evaluate a company. One of the ways to evaluate a company is through their financial ratios. And right now I'll explain to you each financial ratios which are important for the company's evaluation. Do make sure that there are tons of other financial ratios which I have not covered. I'm only covering the most commonly noticed financial ratios for a company evaluation. The first one is price to book ratio. In the simplest and layman terms, it basically tells us that if a company is to sell today, the whole business, what the price of the company should be. It includes equipments, land holding, assets, physical assets which can immediately convert to cash. So the price to book ratio is an important financial ratio for you to understand. The next is price to earnings ratio. It's commonly known as the PE ratio of a company. It basically tells us how much time it would take to make your money from the investment. It's a very highly valued financial ratio and been mostly considered across different sectors. Now do make sure that across different sectors, the base PE ratio, which should be comfortable for investors to make the decision, would be different from companies to companies as well as from industries to industries. The next thing is price to earnings growth ratio. It basically tells us the historical growth of a company on top of the PE ratio. It helps us to understand how speculative a stock is right now or not. After that comes the dividend yield, which is very important for people who are looking to get some income out of their investment. If and how much the dividend a company will provide for your investment per year. It basically is captured by per stock and generally is been noted in terms of the dollar value. It's been mentioned in terms of percentage as well, but the percentage may change depending on the stock prices. The stable companies definitely pays out dividend. Some of the companies which are providing high yield dividend are commonly relying on the debt which it takes from the investors as a part of investment and returns most of it back to those investors while trying to take the company out of debt. So you have to make sure that not all the companies which are paying dividend are a good company. The another way you can evaluate a company is through ROA. It basically tells us how effectively company uses its asset to make the profit. Some of the companies may have a lot of assets and if they do not use it effectively, then they might not be able to make money out of it if they are acquiring a lot of assets. The next thing is ROE. Return on equity is basically tells us how effectively the company is using your money to make profit. After that comes the current ratio. It basically tells us the relationship between the company's assets and the liabilities. And this can tell you a lot about a company or even a person. The relationship between how much liabilities they have and how much assets they have definitely gives you a bigger picture on someone's financial status. The next thing is quick ratio. It's very similar to the current ratio. It basically tells us that how effectively a company is able to complete their short-term liabilities or pay down their short-term liabilities by converting their assets to cash quickly. The next thing is the earnings per share. It is also one of the important things which is considered during the earnings call. The measure of profitability. It basically tells us the measure of profitability of a company, and the higher number is better in this case. Now that you know enough about how you can evaluate a company through their financial ratios, let me give you a quick example so you can learn better from the numbers. Here in Finviz, you can get all the information you need, which I just explained, to evaluate a company and make the decision whether you want to invest in an individual stock or not. You can do the same thing with the ETFs, but ETFs does not make sense when it comes to understanding their PE ratio and stuff like that, because it's not just one company, it's a bunch of companies, right? So let's go understanding individual stocks, and if you have any confusion on whether to buy, for example, Apple or Tesla, you can make a decision based on your comfortability, risk factor, and your evaluation of the company. So for Apple, here as you can see, the PE ratio is 32.4, which is price to earning ratio. Price to earning growth is 4.07, and similarly you have other ratios which I have not explained, but you can always hover over them and understand what it exactly means and can choose your investment based on those criterias. The quick ratio is 0.9, the current ratio is also 0.9. The EPS number right now is 5.89. The ROA is 27%, ROE is 165%, the ROI is 58.30%. And similarly, if we look the same thing for Tesla, for example, then we can see the difference in the number. The PE ratio is 82.83, which is quite higher compared to 32.40 in case of Apple, which basically says that the stock price is overvalued as compared to what you can see in Apple. But as I said, you should not compare just based on these values. Sometimes the sector wise the value differs as well. Some sectors are more stable inherently and they have lower PE ratio even for a highly overvalued stock as well. So do more research before jumping the gun on buying a stock, okay? So the PEG ratio here is 7.63, the quick ratio is 1, current ratio is 1.6, the ROA is 15%, where in the case of Apple it was 27.6%, the ROE is just 27.9%, but here you can see the return on equity for Apple is 165%, which is quite high, right? And similarly the EPS is 3.4 versus here in Apple the EPS is 5.89. Let's try to find out a volatile stock and see what their value looks like. For example, let's consider Coin. Here as you can see, the EPS is negative. It's negative 10.18. Their P ratio does not exist right now. Their current ratio is 1, quick ratio is 1. Their ROA is minus 2%. The ROE is minus 40% and ROI is minus 25.6% here, which basically says that the company is highly exaggerated and totally relies on you investors making that risk or taking that risk in investing in this company and making it profitable and eventually gain that valuation profit if it's successful. Now let's try to pick up another stock, let's say Coca-Cola, and let's understand what their PE ratio looks like. Their PE ratio is 14.9, which is way lesser than Apple and the other companies which we saw. Their PEG ratio is 2.76, their quick ratio is 0.9, their current ratio is 1.10. EPS is 5.67, which is also good. They provide a dividend of 3.57% and the current value of the dividend is $3.01 per stock you own. and the current stock price is around $84. So I hope that gives you enough information you need to understand the valuation of a company. I highly recommend some books I have mentioned in the description of this course so that you can go read them and be a better investor at the end of the day. Now that you understand everything about the stock market you need to know as a beginner investor, it's time to get to the live demo, which you all must be waiting for, and I know a lot of you might have just skipped to this part so you can buy those stocks. So yeah, let's get started. Okay, so now let's start by going into our Wealth Simple app. As you can see, I have already loaded $100 in my account, just making sure that my account resembles and behaves the same as your account when you are opening your account for the first time in any brokerage firm. So let's continue. Now we'll go with buying a stock. So I'll first go into trying to find out a stock which I would want to purchase. For example, I will go with Apple. As you can see in the Apple stock, the current price is $190.69 at the time of filming this video, and let's try to find out some stats about this stock. As you can see, we have the bid price, which is $190.71. The ask price is $190.73. So what bid price resembles is that someone is ready to pay $190.71 for this stock, and the ask price says that someone who has the stock is ready to sell the stock for $190.73. As you can see, there is always a gap between the bid and the ask price. Here it's 2 cents. The more the stock is liquid, which means the more people are interested in buying and selling that stock or probably trading the stock, the lesser the gap will be between the bid and the ask price, and the less volume or the less people interested in trading that stock will have larger the gap between people who are ready to sell the stock and people who are ready to buy the stock. You can also see the popularity of a stock and if you should trust a stock, also based on the fundamentals, but also based on their liquidity and their volumes by looking at the bid and ask price spread. The last price at which this stock was sold was $190.69. So as you can see that the last price was 69 cents. And right now, the lowest bid is 71 cents, which means that the stock price is going up. The opening of this stock today morning was at $190.23. So as you can see, it already moved from all the way 23 cents to last price was 69 cents and all the way to 71 cents. But the people who are ready to sell this are already asking for 73 cents. So the stock is moving up for the day. The highest price the stock reached today was $191.18, and the lowest price the stock reached today up till now was $189.63. And the exchange basically tells us that it's been traded on NASDAQ. The market capitalization of this stock is $3 trillion. As you know that Apple is no longer in the large cap company. It's a mega cap after crossing the $1 trillion mark. The PE ratio, which I already explained to you, is 32.40 for this stock as of now. The 52-week high tells us basically in last 1 year, approximately last 1 year of time frame, what was the highest price of this stock, which is $194.48. So as you can see, it was almost near to the highest price for the last 52 weeks. So the stock is almost at the high of where it should be since last year. And the lowest price of this stock, which is 52-week low, is $124.14, which was the lowest it went within last 1 year. And this 1 year, this last 52 weeks keeps rolling. You'll always see this value changing as well. So the volume tells us how many stocks has been traded today, which is somewhere around 42 million stocks. So which tells us that the volume or the popularity of this stock is pretty high. The average volume of this particular stock, the Apple stock, is around 62 million. It basically tells us that the current volume where the Apple is right now trading is fairly low as compared to its average volume. So today not a lot of traders are willing to trade Apple for some reason. The yield basically tells us about the dividend it provides, which I already explained to you what dividend is, and it's 0.49% at this particular point in time. So half a cent for each stock you own. If a stock is $100, you get 50 cents as a dividend. Provides dividend on a quarterly basis, generally somewhere around February, May, August and November. Okay, so now let's try buying a stock. I'll not choose Apple for this time because obviously the price of Apple is more than $100. I'll click on the buy and sell and select, for example, I want to purchase today the Air Canada stock. So as you can see, the stock is going fairly down today, and the current price is $25.71 Canadian dollar. And I already explained to you how those stats work, so please look at it when you are making a purchase of the stock. If that helps you, that's good. The exchange, as you can see, it's TSX as compared to Nasdaq because it's a Toronto Stock Exchange. Now let's try to make the purchase. To do that, I will click on buy and will select my account and will select how many shares do I want to buy. I'll select one share. And in the order type section, as you can see that there are various different types of orders you can put. The market buy basically tells us that you want to fill at the best available price right now. So whoever is ready to sell at a particular price, the lowest price you will pick and you will just buy that share based on the availability. The fractional buy, as I said, if you want to buy a fraction of the share instead of buying the whole share, you could do that. Some shares are in thousands of dollars. You don't want to buy the whole thing. You only are investing like $100 a month. You could buy a fraction of that share and can still be benefited if that share grows up, right? So if that share gains 20% over next few months, then your fraction of the share also gains 20%. The limit buy is exactly when you know that the stock price should hit certain limits for you to buy. Then at that point of time, you can put a limit buy in which you provide the price you are comfortable with, and when the stock price or someone in the stock market ready to sell their stock at that particular price, then you get filled for that. The stop limit buy is when your stock price reaches a certain limit, that's when your limit price executed. For example, if you want to only think about buying this stock when the stock price goes below $25, but then your limit is $24.90, in that case, you will put the stop price as $25 and then put a limit price of $24.90. So you're buying once the stock price reaches below certain price or above certain price. But we don't have to worry about all this thing. We just say that, okay, I want to go with a market buy. I provide one share is something I want to buy. The estimated cost is $25.72. I click on OK, it tells me what the market order means, and then I just confirm that okay, I want to buy at this price, and the order has been sent, and within few seconds, as you can see, the order will be filled. And now if I go back into my account, you would be able to see that I own one stock of Air Canada. And as the market price of this particular stock is changing, you can see the change in my overall portfolio and the amount of money I own in my account. Here, as you can see, I own one share of Air Canada. The book value, which means that what the price of this share was when I bought it, the average price of this share right now, the percentage of non-registered account, like what percentage it holds in my account. So if I'm holding 10 different types of shares and the amount of shares, then it will basically calculate what percentage of my account is holding Air Canada shares. And today's return tells us how much I have gained or lost in this current share for today and what the total return is for this as well. So as you can see that for now I have lost 1 cent on this stock. Now let me explain to you how the limit buy works. So the same way, I will go back into my order section, and instead of choosing the market buy, I will click on limit buy and will provide the limit price here instead of just continuing with whatever the market is ready to sell me for. So in this case, I am providing $25.60 to purchase this. Right now the price is $25.72. So technically, to buy that one stock, the market has to come down to $25.60 for me to be able to purchase this stock. So as you can see, it goes into the confirmation of the purchase, and I'm clicking the checkbox which tells me for how long should I wait before the order gets cancelled. So there are multiple ways you can select this, not provided in this account, but if you are in any other discount brokerage, you will be able to see if you want to cancel this account, this order by the end of the day if it's not getting filled, or if you want to keep it good till close, which means that it will go on for days and will try to fill it whenever in future the stock comes to that value. But your money for this part, let's say if you are holding on $25, then you cannot spend that $25 anywhere else, and it will be blocked to purchase this stock whenever that moment comes. I'm sending this order and my order is sent for the limit purchase here. And as you can see, my status for this order will be pending. It's not executing right now. Once the stock prices reaches my value, only then the purchase will be executed. But right now the stock price is $25.70. It's not probably going to go to $25.60. So as you can see, it still sits in the pending and it's not getting filled. So for now, I'll just cancel it. Okay, so now you know how to do a market buy and you also know how to do a limit buy. Now let's try to sell our stock. So in this case, I will select the Air Canada here. And as you can see, I own one stock as I said, and I'll click on sell and I'll select my non-registered account. As you can see, just like market sell, I can sell the fraction of the sell or the limit order at what I want to sell. I'm selecting limit here and I'm providing a limit price and I'm providing $25.75 to sell my current stock. And I'm providing how many shares do I want to sell. Because I only own one share, I'm providing one, and then I'm confirming the sale and making sure that it's open until it gets cancelled, and I'm sending the order, and that's it. Once the order reaches this value, it will sell it. As you can see, at $25.75, it's still in the pending state, and whenever the order reaches my price, it will be executed and my shares will be sold and I will make 5 cents out of this trade. So it's simple as that. Now I hope you got a brief understanding of how the stock market works, what you should make sure when buying a stock, and how you should actually buy the stock, how the stats works, how the purchasing works, and how the selling of the shares works. That finishes up our course for the day. So I hope you have learned a lot on this course, and if you did, please make sure to like this video so that it can reach as many people as possible and they can learn how to trade in the stock market as well. Also, please make sure to save this video so you can always refer to it in future, and please let me know in the comments if you have any questions, comments or suggestions for this video. So I hope you are having a great day and we'll see you in the next one.